Welcome to the Deep Dive, your shortcut to being well-informed. Today, we're unpacking a really compelling strategy for building lasting wealth. Basically, getting paid just for owning a piece of a great company. We're diving into the world of dividend stocks, a powerful approach, but yeah, often deeply misunderstood.
Okay.
So our mission for this deep dive, we're exploring 5 specific companies from our research. They're all highlighted for their potential, to provide stable, growing income over the next 5 years. We'll focus on what makes them genuinely reliable. Because, look, this isn't about chasing the highest yield right now.
Yeah.
It's more about understanding stability, patience, and, honestly, the incredible magic of compounding. Often underestimated.
And what's truly fascinating here, especially for you listening, is that strategic shift, isn't it? Moving away from just like quick wins towards sustainable long-term growth. We're definitely not just throwing darts at a board here. We're looking at established businesses, companies that don't just share profits, but do it consistently and increasingly.
Increasingly, that's the key part.
It really is. And we'll use terms like dividend king or dividend aristocrat. Maybe we should clarify those quickly.
Good idea.
Okay, so a dividend king, that's a company that's raised its dividend for 50. Yeah, 50 consecutive years or more. It shows incredible financial resilience.
50 years. Wow.
And then a dividend aristocrat that's at least 25 consecutive years. Again, these aren't just fancy labels. They really represent decades of commitment to shareholders through all kinds of economic weather.
Right. Good times and bad.
Exactly. Understanding why that matters is, well, it's fundamental if you're trying to build a resilient portfolio.
So, okay, let's distill that down. What does this really mean for someone looking to build wealth steadily, year after year? The real secret, and our source material really backs this up, it isn't just finding any company paying a dividend.
No.
It's about pinpointing those reliable world-class businesses with a long proven history of growing those dividends, not just the ones with the highest immediate payout.
That distinction is critical.
Yeah, the whole strategy hinges on those 3 things: stability, patience, and that compounding effect. Just imagine. You invest in a company, its share price goes up, great.
Yeah.
But it also keeps raising its dividend. And if you reinvest those dividends...
You're buying more shares, often automatically.
Exactly. Buying more shares. Sometimes when prices dip, it's like planting a fruit tree that gets taller and gives you more fruit each year, right?
Yeah.
And you use that fruit to plant more trees.
That's a great analogy. That exponential growth over time, that's where the real power lies.
Definitely.
And if we connect this to the bigger picture for you, the listener, this approach is, honestly, a fantastic way to cut through all the noise.
Oh, there's so much noise.
There really is. Information overload.
Yeah.
So instead of constantly reacting to market headlines, you're zeroing in on businesses with, proven track records.
Yeah.
Strong fundamentals.
Solid ground.
Solid ground. These aren't speculative bets. These are giants.
Yeah.
Industry leaders operating in essential sectors, often with really strong competitive advantages, moats, some call them.
Right.
That allows them to consistently generate profits and then return a slice of that back to you, the investor.
Yeah.
It really shifts your focus from the daily market swings
Which can be magnet.
to the long-term quality and, frankly, the financial discipline of the actual business you own a piece of.
Okay, let's dive in then. This is where it gets really interesting. Our first pick, Johnson & Johnson, ticker J&J.
A classic.
Absolutely. I mean, when you think stability, J&J is pretty much the textbook definition, isn't it?
It really is.
We're talking over 130 years in business. It's just incredible longevity. And their product range is just huge. Everything from Band-Aids, we've all used those, to really advanced pharmaceuticals, medical devices, stuff used all over the world.
That diversification is key.
And our research really hammered home its dividend king status, raising dividends for over 50 consecutive years. Think about that.
50 years.
It means they've weathered every major economic storm you can imagine. Recessions, global pandemics, you name it, all while rewarding shareholders with steady, growing income. So for your portfolio, J&J isn't just another stock. It feels more like a foundational cornerstone, for reliable income and long-term growth.
It does. But, for you listening, the critical question pops up. How? How do they actually manage that kind of sustained growth and keep those dividend increases coming decade after decade?
Right. What's the mechanism?
Well, beyond just the sheer diversity of products, which is huge, What stands out from the analysis is their really sophisticated portfolio management.
Oh, okay.
Take the recent spin-off of Kenvue, their consumer health business. Remember that?
Yeah, fairly recent.
That wasn't just random. It was a very strategic move.
Yeah.
It lets both J&J, now focused on pharma, and MedTech and Kenvue, focus on their core strengths, optimize how they use their money, and chase different growth paths more effectively.
Makes sense. Sharper focus.
Exactly. So that willingness to adapt and refine their business structure, plus the essential nature of their healthcare products,
No.
plus that massive global reach, that's what underpins the strong cash flows you need for those long-term dividend commitments. It's not just stable, it's actually quite strategically dynamic.
Interesting perspective. Okay, moving on. Next up is Procter & Gamble, ticker PG.
Another giant.
Definitely embodies that king of consumer staples title. Just think about the brands: Tide, Pampers, Gillette, Crest.
Household staples, literally.
Yep, exactly.
Oh.
These aren't luxuries people cut back on drastically when times get tough. They're products people buy, well, pretty much regardless of the economic climate,
That creates incredibly stable, predictable demand.
which translates into performance. And that consistent performance, it's earned PG another Dividend King title, over 60 years of dividend increases for them.
Even longer than J&J's streak. Amazing.
It is. And what's really insightful from the research is how their trusted brand names give them incredible pricing power.
Ah, the brand value.
Yeah. They're not just selling, detergent. They're selling Tide Trust quality. That helps PG protect profits and keep growing those dividends.
And they can often pass on cost increases more easily than generic brands.
Good point. Plus, their stuff is sold in, over 180 countries? That's huge global diversification. Resilience. It really is like a defensive anchor when the markets get choppy. Investing in PG means you're basically investing in the daily habits of billions of people.
Exactly. And while, some might call PG boring, and the source material acknowledges this.
Yeah. Not exactly flashy tech.
No. But in a dividend portfolio, boring translates directly to reliable income and stability. It's often what you want.
Good point. Boring is good here.
But it's not just about resting on old brands. The company's strategic strength is in its relentless innovation, its marketing muscle, its supply chain mastery. They're constantly tweaking formulas, packaging, distribution, staying ahead, keeping those brands dominant against both premium rivals and cheaper alternatives. How does Tide stay on top when store brands are cheaper?
Right.
It's perceived value, consistent quality, smart marketing. They adapt to sustainability concerns, different product benefits people want. They ensure their brands stay top of mind, protect those crucial profit margins, and that allows for that continuous dividend growth. It's really a masterclass in consistent execution and, subtle evolution.
Masterclass is a good word for it. Okay, next on our list, a truly global icon, the Coca-Cola Company, ticker KO.
Coach.
Coke. The brand's recognized everywhere, isn't it? And for dividend investors, it's a powerful symbol of reliability. Another dividend king, by the way. Over 60 years of increases.
That's 3 kings in a row.
Right. They're often cited secret. Well, it's that unmatched global distribution network.
It's incredible.
You really can find a Coke almost anywhere on Earth. And that network is just a massive competitive advantage. Almost insurmountable.
Definitely a wide moat.
Yeah. Our research also highlights its transformation, though. They're not just about fizzy drinks anymore. They've diversified juices, waters, sports drinks, teas. They call themselves a total beverage company.
Adapting to changing tastes.
Exactly. And what's particularly clever is their business model. It's asset-light, highly profitable. It's a franchise model, mostly. They sell the syrup concentrates to independent bottlers.
Right, so they don't own all the expensive bottling plants and trucks.
Precisely. It optimizes their capital, gives them that global reach without tying up billions in physical assets. And even with health trends shifting, KO is adapting. Coke Zero Sugar is huge, right? They're expanding into healthier options.
You have to.
It's why legends like Warren Buffett have held KO for decades. So for you, the listener, Coca-Cola offers a solid yield and, a near certainty of future growth. It acts as a defensive stock because people still buy those affordable treats, even in tough times.
Little luxuries.
Yeah. You're essentially buying a piece of a global empire that pays you to own it.
Indeed. And the power of that brand equity, plus their adaptability. That's what makes Coke's seemingly simple business model so incredibly effective.
Simple but powerful.
They've built this emotional connection with consumers worldwide. Incredible loyalty. But the insight here is more than just the brand name, that asset-light franchise model. It gives them immense economic leverage.
Leverage, okay.
They're basically a high-margin brand and concentrate business. They let others handle the heavy lifting, the capital costs of bottling, distribution. This lets them generate huge amounts of free cash flow.
Which they can then return to shareholders.
Exactly, which is then returned to shareholders. So even as tastes evolve, their strategic diversification and their ability to leverage that massive distribution network mean they can push new products out effectively and maintain their market position. That financial resilience is absolutely key to their ability to keep raising those dividends year after year. It reinforces their status as a truly reliable income generator.
Okay, really well put. Now let's shift gears a bit. A different kind of dividend income with realty income. Ticker O.
The monthly dividend company.
That's right, often known as the monthly dividend company. And that's a really unique, very attractive feature for income investors, isn't it?
It really is, that regular cash flow.
Unlike most companies paying quarterly, realty income pays out monthly. Perfect for steady, predictable income. Now, this company is a real estate powerhouse. It owns thousands, literally thousands, of single-tenant properties.
Single tenant, yeah.
And they're under long-term triple net leases. Maybe explain triple net quickly.
Sure, triple net, or NN, basically means the tenant, not the landlord, is responsible for paying the property taxes, the insurance, and the maintenance costs for the building.
Which significantly reduces the landlord's operational expenses and risk.
Precisely. Leads to very predictable income for realty income.
And look at their tenants, Walgreens, 7-Eleven, FedEx. Incredibly reliable, often recession-resistant businesses.
Strong, stable tenants are crucial for this model.
Absolutely. And realty income, it's a dividend aristocrat. It boasts over 600 consecutive monthly payments.
That's over 50 years of monthly checks. Incredible consistency.
It really is. So for anyone looking for consistent passive income from real estate, but, without the headaches of being a direct landlord.
Fixing toilets and whatnot.
Exactly. Realty income definitely deserves a spot on your watch list.
Yeah, the stability inherent in realty income's business model is, it's a major differentiator. That triple net lease structure is pivotal. It de-risks the landlord side so much, leading to those highly predictable cash flows.
Predictability is key.
It is. Furthermore, what the research highlights is the diversification, not just the number of properties, but across tenant industries. You mentioned convenience stores, drugstores. They also have logistics, manufacturing tenants.
Spreads the risk.
Helps insulate them if one sector has a downturn. Another key aspect, those long-term lease agreements, often 10, 15, even 20 years. And they typically include contractual rent escalators.
Built-in rent increases.
Guaranteed rental growth over time, built right into the contract. This provides a very clear path for consistent income increases, and it underpins their ability to maintain that amazing monthly dividend track record. It's a really sophisticated way to approach real estate for income, going way beyond just owning a building.
Very cool. Okay, rounding out our list of 5. PepsiCo. Ticker PEP.
The other beverage and snack giant.
Exactly. A true snack and beverage empire. PepsiCo isn't just about soda, right? It owns this incredibly diversified portfolio. Frito-Lay, think Doritos, Cheetos, Lay's, Quaker Oats, Gatorade, Tropicana, countless others.
Snacks are huge for them.
Huge. This dual focus on snacks and drinks creates an incredibly powerful, diversified business. Our source material points out, kind of cleverly, that when you buy Doritos and Pepsi, you're supporting the same company twice.
Good point.
And that creates these incredibly stable, resilient revenue streams. Less susceptible to economic swings than maybe just one category would be.
Makes sense.
And guess what? Another dividend king, PepsiCo. Over 50 years of dividend growth.
That's 4 out of 5 are kings. Impressive list.
It is. Their strong cash flow allows them to fund massive marketing, continuous innovation, and, crucially for this discussion, that consistently growing dividend.
But they reinvest heavily in the business too.
They do. They're also proactively adapting to changing tastes, just like Coke, offering healthier snacks and drinks, investing heavily in those better-for-you products. That forward-thinking approach gives confidence in their long-term growth. It offers you, the listener, both stability and exposure to that fast-growing snack market. It's a mix of iconic brands and a really forward-thinking strategy.
Yeah, PepsiCo's strategic advantage really lies in leveraging that dual market dominance.
Yeah.
Snacks and beverages. For long-term growth, and yes, dividend reliability.
How does that synergy work exactly?
Well, the snack business, especially Frito-Lay, often throws off incredibly robust cash flow and high margins. Very profitable.
Yeah.
While the beverage side offers that global scale and massive brand recognition. But the synergy is deeper than just buying twice. Think about shared distribution networks getting chips and soda onto the same truck, into the same store.
Efficiency.
Big time. Integrated marketing campaigns that cross categories, leveraging extensive consumer data from both sides to drive product innovation. How do they know what new Doritos flavor might pair well with a new Gatorade variant?
Ah, the data.
Their combined market intelligence is formidable. So this synergistic relationship lets them maintain a really strong financial position, consistently invest in their brands, launch new products, and adapt to consumer trends with agility. All of that underpins their consistent dividend growth and makes them a very compelling long-term hold.
Okay, that makes a lot of sense. So there you have it, our 5 dividend titans. Johnson & Johnson, Procter & Gamble, Coca-Cola, Realty Income, and PepsiCo.
A solid lineup.
Yeah. And the core message here seems undeniably clear, doesn't it? These are not speculative bets you hope will just shoot to the moon overnight.
Definitely not.
These are world-class businesses. They have a profound, proven commitment to their shareholders. They share these powerful traits: enduring stability, incredible resilience through economic cycles, vast global reach, and a demonstrated dedication to consistently rewarding the people who own a piece of their success.
And, this raises an important question. How do these kinds of businesses actually contribute to building enduring wealth over a lifetime?
Good question.
The consistent theme across all 5, really, is their fundamental strength. Their ability to generate reliable cash flow through thick and thin, often in industries that are just essential to daily life.
Right. Things people need or consistently want.
Exactly. So holding and reinvesting dividends from companies like these, it isn't just an investing strategy, it's a proven patient path to building substantial wealth over time. They let you participate in the growth of established economies, global consumption, while getting a regular and hopefully growing income stream.
Patient being a key word there.
Very key. And, our discussion today, as always, has been an impartial look at the insights from the source material, just for your consideration, focusing on the how and the why behind their success.
That's right. So what does this all mean for your financial journey? Well, it means understanding that while these companies, they offer compelling characteristics, the absolute most crucial step is always
Do your own research.
do your own research before investing. Always. Make sure any stock, including these 5, truly fits your personal goals, your risk tolerance, your overall financial strategy.
It has to fit you.
Exactly. This isn't just about picking names off a list. It's about aligning your investments with your long-term vision and really understanding the underlying businesses you're essentially partnering with.
Well said. And maybe for further reflection, I'd encourage you to consider how understanding that core business model, where does the revenue come from? What are the competitive advantages? Is there really a commitment to shareholders? How understanding that truly empowers you.
How so?
It helps you see wealth creation as more of a journey of partnership with these established companies rather than just chasing stock tickers up and down.
A different mindset.
A different mindset. It encourages a deeper look. So based on the principles we talked about today, longevity, consistent dividend growth, essential products, global reach. Here's a challenge for you listening. What other companies in your daily life maybe demonstrate that kind of enduring quality and commitment? Who else might fit this dividend king or aristocrat profile in your own estimation? Something to think about.